Index investing explained. Index investing is my favourite way to invest, and from my experience it's passive, other than the initial research, and it's stress-free. Index investing is a passive investment strategy that seeks to replicate the performance of a selected market index. A market index is a collection of stocks that represent a specific segment of the market. For example, a UK index is the FTSE 100, and this tracks the 100 best performing companies in the UK. A popular US index is the S&P 500, and this tracks the 500 top companies in the US. An index fund is where a large number of investors pool the money together into one fund that is looked after by the fund manager. I invest via Vanguard, so the fund is managed by a Vanguard manager. The fund manager looks to match a particular index, like the FTSE 100, for example. Your fund has a small slice of several companies, so your risk is reduced or spread out. This is safer than investing in one stock. Index funds are usually made up of a mix of stocks and bonds. A very popular split has been 60-40, which is 60% stocks and 40% bonds. Before we go any further, I will explain what stocks are and what bonds are. Shares. The stock of the company is sold in units called shares. A share is a unit of ownership or equity in a company or corporation. Stocks, shares and equities are basically the same thing. Bonds. This is where you make a payment, like a loan, to a large organisation, like a government, and then they pay you interest. The interest depends on what bond you invest into. Your index fund can be made up of high-risk stocks, medium-risk stocks, then low risk. Low risk, we're talking property, bonds and gilts. Gilts are bonds issued by the UK government, for example, to raise money. We are now going to touch on your risk tolerance. Simply put, you can go high risk, medium risk or low risk. So when you look at emerging markets, they are seen as very high risk. Then you have Japanese equities, European equities, US equities and UK equities. And these are about in the middle. Again, reducing your risk, you start looking at property, bonds and gilts, and this is low risk. If you speak to a financial advisor, this is something they're going to cover in detail. Do your own research, and if you have enough of an understanding, you can be your own financial advisor, and this will save you money. Maybe speak to a financial advisor if you lack the confidence to do it alone. This is an option many investors go with. If you're in your early 20s and are planning on investing for the next 30 years, you can go high risk and ride the inevitable market ups and downs. So you might go 80-20, 80% stocks, 20% bonds, or might even go 100% stocks. If you're in your 50s and have some serious money built up, you are going to be thinking preservation and low risk. And in your 50s, you might think a 40-60 split of shares and bonds to reduce your risk, or even 20-80 split so you have mainly bonds. The more you learn about index investing and investing in general, the greater your understanding of what your risk tolerance actually is. Many investors go with actively managed funds to try and beat the market. Index funds tend to be a low-cost, passive option that are well suited for hands-off, long-term investors. This is me, a long-term investor who wants the investments to be as passive as possible. Actively managed mutual funds can be riskier and more expensive, but they do have the potential for higher returns over time. Around 90% of actively managed funds fail to beat the market. Just bear this in mind. With some index investing basics covered, we are going to move on to why index investing is a good option for beginners. 1. Diversification. Index funds offer instant diversification, allowing investors to spread their money across a broad range of companies and industries. 2. Low fees. Index funds typically have lower management fees than actively managed funds. 3. Simplicity. Index investing is a straightforward investment strategy that does not require extensive knowledge about the stock market. Investors do not need to research individual stocks or try to beat the market. 4. Consistency. Over the long term, index funds tend to deliver consistent returns that closely match the market average. This removes the need to worry about picking the right stocks and instead allows investors to focus on their long-term goals. Educate yourself and read books by John Bogle, Warren Buffett, Ray Dalio, Tony Robbins, Andrew Craig and David Sawyer. These books have helped me to understand the fundamentals. Take your time to choose your fund. I started with a Life Strategy 80/20 fund, but have recently moved to a Life Strategy 100 fund because bonds aren't very good when inflation is high. Let's have a little recap of the main points before we finish up. 1. Index investing is a passive investment strategy that seeks to replicate the performance of a selected market index. 2. Index funds offer diversification, allowing investors to spread their money across a broad range of companies and industries. 3. Low fees. Index funds typically have lower management fees than actively managed funds. 4. Simplicity. Index investing is a straightforward investment strategy that does not require extensive knowledge about the stock market or a particular stock. 5. Over the long term, index funds tend to deliver consistent returns that closely match the market average. In conclusion, index investing is an excellent investment option for beginners who want to invest in the stock market but don't want to take on the risks associated with individual stock picking or actively managed funds. Anyway, that'll do for now. I'll see you on the next one.